Welcome friends to this webinar on modeling a live case. We are talking about Accenture company and we will learn about how to model a cash flow statement. Just a quick check. Am I doing okay? Can you hear me? Nicole says yes. I hope rest of you can hear me as well. Victor says you are loud and clear. Okay, so we are all set. So as I go through this webinar, feel free to post any questions that you have. It will be answered there and then. My plan is to cover full financial modeling of cash flow statements, and I'll take you through the Excel model and show you the tricks and the important formulas that you need to link in order to get your cash flow rights. Okay, as more people join in, let's get started and start with a quick introduction about EduPristine. EduPristine is an authorized training provider for CFA, and they have been conducting training for last several years. They're also associated with GARP, which is the FRM Authorized Professional Association. It's called Global Association of Risk Professionals. FPSP India. EduPristine is authorized training provider of CFP training, Certified Financial Professionals, and Primea, which takes care of PRM and APRM foreign certification. So where all these financial modeling trainings have been conducted, the associations are with Ernst & Young, Bank of America, JP Morgan, and various other big banks. Not only big organizations, we are associated with academia, the National University of Singapore, IIM Calcutta, FMS, and various other institutes have been involved in not only conducting training at these centers, but also working with their professors to get our content in shape. And finally, we have got presence across the world, online presence almost every part of the world, and the training centers are at Singapore, Middle East, USA, that's what we are targeting right now, and all the major cities of India. Finally, conducted successful training for more than 700,000 man-hours across 21 countries. Okay, so let's get started with our today's plan on modeling cash flow statement. So as you might already be aware that cash flow statements can be created. It can be created in two ways. One is a direct method and another is an indirect method. The direct method involves collecting all the cash receipts and doing addition of all inflows across the year and subtraction of all outflows across the year to get the net cash flow. Now this is a useful method when you are sitting inside the company and you have access to all the receipts that happen in cash. But if you are sitting outside and you have annual reports of a company, which is a secondary resource to you, then you use an indirect method where you try to compute cash flow from income and balance sheet. So you pick the existing financial statements like income statement and balance sheet, and you try to use the data to compute the cash flow changes in the company. And the next step is to compute free cash flows, project these cash flows to value a company. After valuation of the firm, you value the equity, you divide it by number of shares outstanding to get share price. And once you got the share price using fundamental valuation, just like what Warren Buffett does, who believes in fundamental valuation based on present value of all free cash flows to the equity. What do you do next? You get the share price, you compare it against the markets, and if you see that market share price is lower than your computation of share price, you say market is undervaluing this share, let me go long on it or buy it. And if you find it otherwise, that market value is much higher than your fundamental valuation based on free cash flows, what do? You go short and you sell it because market is overvaluing this stock. Okay, so that's the end in mind. My end is to go for fundamental valuation, and to do that I must know the cash flows for future projected years. Now in order to project the cash flows, I must be able to compute these cash flows from income statement and 2-year current and previous year balance sheet. Okay, so that's the plan. And now we'll take a look initially at the slides and see how it's done, and we'll spend rest of our time on the model itself and see how it's computed. Okay, so any cash flow, if you want to compute using indirect cash flow method, it will start with the net income of the same year. That's important. The year matching has to be done in a large model with large data. I have seen people making mistake. They link 2010 with 2011, and that makes all the analysis shifted by 1 year and hence cause incorrect results. Okay, so one way to ensure is that we put 2011 in exactly same column across all these statements. So let's say this one was column D in my Excel sheet. Now 2011 will be linked to column D in income statement, in balance sheet, in cash flow statement, so that I can see easily that all formulas are linked to column D. Okay, that's the quick learning about data layout. And then you get started with net income, right? And you get it from income statement or P&L statement, as they call it, the profit and loss. The net income is based on accrual basis. Okay, I hope many of you are aware that the net income is not based on cash flow, but based on a matching concept where the revenues are matched with the expenses in that year, and they are based on revenue recognition policies and expense recognition policies, which has nothing to do with cash. Okay, and it's accrued based on how much work or activity has been done, independent of whether you have received cash or not from your customers, or whether you have paid cash or not to your vendors. So it's important that I adjust net income to get the cash that got transacted during the year. So it's important to know that cash flow is during the year. It's unlike balance sheet, which is a snapshot at a particular time. Cash flow and income statement talks about changes, incremental changes, positive or negative, that happen during the year. Okay, so I start with net income, add back depreciation, amortization, and impairment, because these are non-cash charges that I had subtracted to reach to the net income. So since I had subtracted them, I have lowered the net income. I need to add it back because there was no cash outflow. If you have paid someone based on shares and you have shown it as an expense, you better add it back, okay, to get to the cash flow. We are starting with cash flow from operating activities, okay, and we do not include interest income in cash flow from operating activities, because interest income or interest expense, anything related to interest, right, goes to either investing activity or it goes to financing activity. Okay, so as per US GAAP, I would like to remove interest income and interest expense from cash flow from operating activity. So you say I reverse their nature. So remember, I added interest income to reach to the net income. Now this time I'm reversing, subtracting. I subtracted interest expense to reach to the net income. This time I am adding it back. Now why I am adding back? Because I want to get to the cash flow from operating activities. Similarly, any increase in deferred income tax is added back. Increase in income tax payable is added back. And that's the point. The red box right here, the dotted red box talks about any adjustment to P&L statements to reach to cash flows. And the next one talks about any changes that happens in the balance sheet needs to be taken care. Now you need to remember that any increase in asset is a cash outflow. And how do I look at increase in assets? So for operating activities, I look at increase in current assets. And if current assets have gone up this year, for example, accounts receivable, if accounts receivable has gone up, the intuition is that you have not received cash from your customers. And if you have not received cash from your customer, what does that mean? That means there is a net cash outflow. There is a reduction in cash as compared to net income, which is showing a higher net income because revenue has been recognized, and the revenue which has not come in cash will increase the account receivable. So it will increase the asset. So remember this, that when asset, the net change in asset goes up during the year, then it's called a cash flow. In terms of cash flow, this is nothing but an outflow. And the reverse is also true, that when asset goes down, account receivable goes down this year, that means there must be an inflow of cash. Okay, so that's an inflow of cash. On the other hand, if you look at liabilities, as expected, if liabilities goes up, for example, taxes payable. If you have not paid your taxes in cash and tax payable goes up, okay, or accounts payable goes up, you have not paid to your vendor, your supplier in cash, you have recognized that as an expense, but since you have not paid it in cash, the accounts payable goes up, so liability goes up, which is in some sense a cash inflow. So that's an opposite nature, and I call it cash inflow. So remember this, and what we're going to do here is look at the change in current assets in the balance sheets and change in current liabilities in the balance sheet to adjust this part of the cash, and I reach to the cash flow from operating activities. Okay, so that's one segment of cash flow. Any questions here? Okay, so let's keep moving. We'll talk about cash flow from investing activities, and here we look at increase in the investments, which is like increase in the assets is actually reduction in cash flow. Can you see a negative sign here? Yeah, that's right. I just explained that increase in asset is treated as cash outflow. If you have bought an asset, there must be cash going out of the company. Similarly, increase in investments, long-term investments, any capital expenditure, building a plant, property, okay, any goodwill, which is an asset, all that results in reduction in cash flow. and the money that you get from investments like interest income, right, all that gets added to give you cash flow from investing activities. Okay, so remember this one, the asset and the liability. Increase in liability is inflow and increase in asset is outflow. Okay, the last segment we'll talk about is the financing activity, and of course we will model everything today, but to get the idea right, the cash flow from financing activities looks at all the debt and equity of the company, and as you increase the liability, that means more cash is coming in into the company, and just like you see that the current portion of long-term debt, if there is an increase there, you add it as a cash flow from financing activities, and if there is an increase in long-term debt, paid up capital, treasury shares, all this increase right here, from here to here, is an increase in liability from the claim holders, and that's why that's an increase in cash flow. Okay, and then you look at down below, that's, you know, the expense that you pay. You are paying out interest to your debt holders, you are paying out dividend to your shareholders, and other payout from the retained earnings. All that is an outflow in cash from financing activities, and that needs to be subtracted, and that gives us the net cash flow from financing activities. Okay, so keep that in mind. Okay, and now with this basic understanding, let's jump to our Accenture model. Okay, so this is the model, the complete valuation model that was created for Accenture company, and let me give you a quick idea about the assumptions and other statements before I talk about cash flow. Accenture is a consultancy company, and we have divided it into various segments like management consulting, technology, system integration. They also outsource a lot of work, so application, infrastructure, business process outsourcing. So the first thing is to compute the growth drivers. So we pick the growth drivers as the utilization of consultant, projected them for future. So you can see that 2013 onwards is all projections based on the annual reports data. So we projected the future, and we picked the past data of income statement. You can see this is 2010, 11, 12, and some part of 13. So this is all taken from annual reports. So you can go to Accenture website, go to Investor Relations, and download all the past balance sheet and income statements. That's what we did, and put it in a template. And in one of the webinars, we actually explained how to create balance sheet, how to create P&L. And today we'll not focus there, but all I'll show you is that look at column D here. This is column D right here. It represents 2010 in the income statement. And let's go to balance sheet. Can you see column D? It also represents 2010 in balance sheet, and you would expect same thing, 2010 in cash flow. Okay, now this way, whenever I am talking about 2010, the formulas will talk about column D. That's the layout I was talking about. So like in every other income statement, you've got revenue, you've got operating expenses, you've got operating income, EBIT, and you remove the interest part, you get EBT. earning before taxes, you remove the taxes to get net income. Okay, so that's what is the P&L. Then you go to balance sheet, you've got current asset, non-current assets, current liabilities and non-current liabilities, and the balance sheet should match. Asset should be equal to total liabilities and shareholder equity. So we've done all that. Our job is to compute the cash flow statement. My question to all of you guys is, why can't I compute 2010 cash flow statement? Why is it kept empty? Why am I starting from 2011? So that's the quiz. Why not 2010? So once again, I had 2010 income statement, I had 2010 balance sheet, but I could not create 2010 cash flow statement. And John is right, and John is saying that to create 2010 cash flows, you must have 2009 balance sheet, because in order to look at change in the assets, you don't just need 2010, you not only need the same year, you need previous year as well. And since your balance sheet starts from 2010, right here, since your balance sheet starts from 2010, you don't have 2009, so how would you compute 2010 cash flow? That's the right answer. So I'll always start 1 year ahead of my cash flow. Okay, so that's the cash flow, and I'll go over one column of the cash flow right here and show you how we have computed it. And you will find that there are three big formulas. There are three big things that we have done, and we are repeating those three things to get the cash flow right. Thanks, John, for answering that. So let's look here. The very first thing I'll do is, on my right, I'll create some notes. Can you see here the notes here? In this column, I have created some notes, and the notes I have done is from where I'm gonna pick this guy. For example, this will be picked from P&L because it's talking about net income. Can you see there? This is P&L. Don't worry about future cash flows. Let's just remove them. Just look at one column, and rest is a copy paste. So this is from P&L. The depreciation amortization also comes from P&L for past years, and it comes from asset modeling for future years. In one of the webinars, we'll show you how to model an asset for future computation of depreciation. But right now, just assume it is coming from P&L for past years. Any share-based compensation, again P&L for past years. Interest income, interest expense, all comes from P&L. Then I talk about current assets, which is receivables, unbilled services, deferred income tax, and other current assets, anything which is a deferred contract cost, all this. Then I look at the liabilities, accounts payable, deferred revenues, and all these current liabilities till here all come from balance sheet items. Okay. So why I have earmarked them as BS, the balance sheet, because now if you look at the formula here that I'll apply, always have balance sheet items. Can you see that? Let me just increase the font so that you can easily visualize it. So look, the formula here, they are all balance sheet formulas. And I know 2011 belongs to E column. So every formula will have E column minus, because I want to look at the change, D column. So you can say it is E minus D. The row will change, but it is E minus D. That's the layout, and a quick check. I am sitting in E column. Can you see E column? 2011 represents E column in all the sheets, and D represents year 10. in all these sheets. So that's the change, E minus D, balance sheet. Okay, so I have earmarked them with the balance sheet. So that's the first step. Mark everything on the right. And cash flow from investing only comes from balance sheet. Long-term assets, long-term liabilities, again from balance sheet. So first step, earmark. Step 2. Step 2 is link it to the P&L. So can you see P&L E30? All I can say, column E represents 2011 and the sheet is P&L. So I'll go there and see, look at this cell right here, and it is P&L net income for 2011. So I link this cell in my cash flow statements and I say link it to P&L, then add back the depreciation. You pick it from asset modeling. This is the whole asset modeling schedule and we have projected it for future years, and in one of the webinars we'll show you how to do that. But today assume that this was taken from past data, again 2011 data. So this is 2011 data we are talking about here, this number, and it is also linked to the cash flow statement. I keep moving down, add back share, add back the interest income from P&L, add back interest expense from P&L. So I can take you there and see that this is the P&L interest expense. So I keep linking and adding back based on my template that I have created. And once I am done with all the P&L adjustment, so once you are done with all the P&L adjustment, what you get is net income adjusted for cash flow, and it's time to talk about balance sheet. So once you get into the balance sheet and you look at all the current assets, right, these are all current assets till this point, and we know any increase in current assets is a net cash outflow, so I put a little negative sign in front of that. In other words, what I'm going to do is I'm saying change in asset is current year, that's my current year. Can you say column E, current year, minus previous year, which is column D. The row has to be same, E9 minus D9. So what's that? This is E9 minus D9. Can you see here? So from column E, pick the 9th row which talks about receivable from client. Okay, and that's what I'm talking about here, receivable from clients. So I take the difference of current year minus previous year, which is nothing but change in accounts receivable. And I can see the change is positive. A positive change means I have not received the cash flow. And I have not received the cash flow. That means it has to be a cash outflow. So I put a negative sign here, but I keep computing all these things. Change in unbilled services, change in deferred income taxes, and you know what? What I'll do in the end while computing the net cash flows, you can see I have subtracted these current assets. So right here, can you see a green color? That's green color is what I have subtracted because increase in asset is a cash outflow. Okay, so you can see that I have added all these change in assets and put a negative sign. Okay, and the idea was that I need to reduce, subtract it to show reduction in cash. So that's all red, and I have computed change in cash flow here. Same is what I'll do with the current liabilities. The only difference is that change in current liabilities will be a cash inflow. So I look at all these guys. Let's look at accounts payable. So I link the accounts payable, and I say accounts payable is linked to right here, this part of the balance sheet. Can you see change in accounts receivable 2011 minus 2010? That's all what I have to do. So what I do is I go to the accounts payable and say let's delete it and start it again. So I say equal to control page up. I'm using shortcut to navigate, and I say my accounts payable is right here, year 2011. I say minus, use my arrow keys to pick 2010, press enter, and that's how I link it. Okay, so you don't like so many decimals, so you can just make it 2 decimals. Same as what I do with deferred revenues, accrued payroll. Again, you can see balance sheet current year minus last year, and that's all I'll check, right? Everything is E minus D, same row, E40 minus D40, E41 minus D41 from balance sheet, and then I get my net cash flow from operating activities. Okay, so I'm focusing here the final sum. Let's look at the formula here. So I add all the things from net income. I subtract E9. So let me just show you what am I subtracting. So wherever I have put a negative sign, I subtract that. So I remove the interest income, reduce it, other income expense. I subtract the sum of all the assets and add sum of all change in liabilities. So that's what the big formula that you can see here, right here. Net income, add back depreciation, subtract interest income, right? Add back interest expense, then subtract change in asset, and finally add change in current liabilities. All that will give you cash flow from operating activities. Okay, so once we got this is one of the important pieces, cash flow from operations. Then we move to investing activities, and by the way, these are all real numbers, and they belong to an Accenture company which got valued by us and recommended their share price, the fundamental share price. All these numbers are real numbers. You can match it against their income statement or balance sheet. Okay, so we've got 2 things left. One is the investing activity cash flows, and then financing activity. So we've learned 2 things. First is the earmark. Second is make sure you have computed your operating activity by adding back the non-cash activities. And third thing is to subtract change in asset and add change in liability. We'll apply the third concept here again. Any increase in long-term assets like investments, capex, goodwill, all that will be subtracted. So once again, in the balance sheet, I look at change in short-term investments, change in other investments, change in the capex, change in goodwill. Let's go there and look at the goodwill. Now this company must have made some acquisitions, and that's why they have a goodwill here. Can you see these 2 numbers? And what I have done, current year minus previous year, that's goodwill, and here are other investments. So all non-current assets difference, right, is captured here in my cash flow, right? So I got it here. And any depreciation amortization that was used, again, is a non-cash activity, and I subtract it. So here is the total answer where I put a negative sign. If you be careful here, I have put a negative sign here. Let me just show you that there's a negative sign in front of the sum. That means increase in asset is a negative number, and then you add back any interest income. That's what you receive and you subtract the depreciation amortization because you have incorrectly included it in one of the components, so I subtract it. So that's the cash flow from investing activity. It's quite negative. That means company must have made investments this year, and any investments results in outflow. Okay. So that's the final thing. The financing activity consists of all the liabilities. Mostly when you take more debt, you take more treasury shares, you launch new shares, you do an FPO, okay, you issue bonus, you issue rights, all these, when you issue any instruments in the market and you make your shareholders to buy those instruments, what happens? You receive cash, okay? So again, it's an increase in liability, the same old concept. Increase in liability is cash inflow. So again, I look at the balance sheet and say, well, balance sheet, current year minus previous year for increase in current portion of long-term debt. So I'll go to the balance sheet and say, let me look at where is captured. So here is the current portion of long-term debt. You can see all the line items here repeat in the cash flow. So I go here and let me fill it. So let's remove the first two and fill it here. So equal to, go to the 2011. So make sure don't go to 2010. 11 minus 2010. That's it. Okay. Similarly for long-term debt, go to the balance sheet and look at where is my long-term debt. Right here. Can you see long-term debt? So current minus previous, and that's how I link it. And that's how I link everything. And any increase here is a cash inflow. And if you pay back to your stakeholders are your debt holder and shareholder here. If you pay back in the form of interest or dividend, all that will be subtracted. So I put and link all the payments. And finally, I take a net of liabilities increase minus dividends or interest payout. And that difference gives me the cash flow from financing activities. Okay, so I've got all the three linked. Mind you, I'm not worrying about other columns. My only aim is to worry about one column, and once I have completed it, what I'll do is I'll go down till my financing activities and I just copy everything and paste it on the right for rest of all the columns. Since everything is a formula and the formulas are relative, okay, I have not put an absolute dollar sign, so everything will get copied and they will link nicely. For example, this is linking to column F, P&L, which is 2012, column G, P&L 2013. So you can see G is 2013 and everything got linked nicely, and I've got it for all future years. The last thing I have to do once I've got cash flow from financing activities to get the net cash flow, and as you expect, it is the sum of all the three net operating, financing and investing cash flow. So I add all the three cells. So this is during the year cash, and I would like to know the total cash at the end of the year. So how to get that? The total cash at the end of the year. So you pick the opening cash balance from the balance sheet. This was the 2010 opening cash balance. Now you pick that, come to the cash flow statement. Okay, you add during the year cash, and that gives you the total cash. Okay, as you can clearly see, the starting balance during the year, the sum is end of the year. This end of the year become next year beginning cash. So these diagonals will always match in your template. Can you see that? So the ending balance will be next year's beginning balance. So I'll link all these things like this right here, and I'll keep adding this year's cash flow. This is the change in the cash flow during the year. I'll choose a different color which highlight, yeah, this one is good. So this is the change during the year, and I keep adding the beginning balance cash flow and computing the net closing balance, which will go to the balance sheet. Remember, when we did the balance sheet, we said we will link the cash flow in the end. Cash flow is an adjusting quantity which will be linked in the end. So I compute the closing cash flow by picking the beginning cash flow, adding the change, and I link this final cash flow to the balance sheet. Okay? And that's how I get the final closing cash flow in my model. And once you have got this cash flow and linked to the balance sheet will start matching. Okay, so any question at this stage? Okay, if there are no more questions, let's do a quick recap. We said that we'll compute cash flow from operations, investing, and financing. The second point was pick the net income from P&L to get indirect cash flow, add back depreciation, any non-cash charge, subtract interest-related things so that you get CFO, the cash flow from operating activity. Any increase in asset, remember, is a cash outflow, and any increase in liability is a cash inflow. So we apply that concept to get investing and financing activity. Make sure your data is laid out nicely. Make sure you have linked your cells correctly. If you have got it right for one column for 1 year, you will do a copy paste. The formulas are relative and they will copy on the right to give you the cash flows for all future years. With that, I am done. Thanks a lot for your time and patience. Hope you got to know something which you didn't know before. Feel free to post your questions. I'll be here for next 10 minutes and I'll answer personally. Till then, thank you very much and have a nice rest of the day. Thank you.